Have you ever wondered how the concept of consumer credit and debt originated in America? Let's take a step back in time to the colonial period, where the roots of our modern credit system first took hold. In those early days, the economy was primarily based on bartering, a system of exchange where goods and services were directly exchanged for other goods and services with no intermediary of money. However, as the colonies began to grow and trade expanded, a new system was needed, one that could facilitate the increasing complexity of transactions. Enter the British merchants. They recognized the potential of extending credit to their American counterparts, effectively setting the stage for the birth of consumer credit. The British merchants would provide goods on credit, expecting repayment later, usually after the harvest season when the colonists had goods to sell. This system not only allowed the colonists to acquire necessary goods and supplies when they were short on cash, but it also created a bond of trust between the merchants and the colonists. The use of credit by these merchants was a significant driver of economic growth during this period. It fueled the expansion of trade and commerce, allowing for a more fluid exchange of goods and services. The credit system was not without its challenges, of course. Defaults and delinquencies were common, and the lack of a standardized currency often led to disputes over repayment. But despite these hurdles, the system persevered and adapted. This era marked the transition from a simple barter system to a more complex system of credit, laying the foundation for the consumer credit systems we see today. In essence, the colonial period was a pivotal point in financial history. It was during this time that the seeds of consumer credit were sown, setting the stage for the intricate web of financial transactions that we navigate in our daily lives today. From bartering to British merchants, the seeds of consumer credit were sown in the colonial period. The 19th century marked a turning point in the history of consumer credit. Can you guess what it was? As we journey back in time, we find ourselves in the midst of the Industrial Revolution. Commerce was thriving, businesses were expanding, and a new player entered the financial stage: banks. The rise of banks in the 19th century was a game changer. Before banks, credit was largely a personal affair, a matter of trust between individuals. But with the introduction of banks, credit became institutionalized. Banks took on the role of middlemen, lending money to those who wished to invest and expand. They made it possible for businesses to borrow large sums of money with the assurance that they could pay it back over time. But the influence of banks didn't stop there. They were also instrumental in establishing the first credit systems. These systems revolutionized commerce by allowing businesses and consumers to buy goods and services on credit. Imagine being a shopkeeper in the 19th century, having the ability to sell goods to consumers who could promise to pay you back later. This was a radical concept at the time, and it opened up a world of possibilities. The establishment of these early credit systems was a turning point. It meant that credit was no longer just for the rich or the well-connected. Anyone with a good reputation could now access credit, and this democratization of credit played a major role in fueling economic growth. Banks and credit systems also provided a level of stability and predictability. They made it easier for people to plan for the future, knowing they had access to funds when they needed them. This was a far cry from the uncertainty of earlier times when credit was largely a matter of personal trust and goodwill. But as we know, the story doesn't end there. The rise of banks marked a significant shift, setting the stage for the modern credit system we know today. These humble beginnings laid the groundwork for the complex web of financial institutions and credit systems that underpin our modern economy. So next time you swipe your credit card or take out a loan, remember the significant role banks played in making it all possible. Did you know that the government played a key role in the expansion of credit in America? As we navigate through the annals of history, it's fascinating to uncover how the government's intervention shaped the landscape of credit in the United States, particularly following World War I and during the Great Depression. In the aftermath of World War I, the U.S. government sought to facilitate economic growth and recovery. Recognizing the power of credit as a catalyst for growth, the government took active measures to expand it. This intervention was a cornerstone in the development of modern credit systems, as it put the wheels of the economy back in motion and created a ripple effect of prosperity. The Great Depression, a period of economic hardship unlike any other, brought a renewed focus on the role of credit. As banks crumbled and the financial system teetered on the brink of collapse, the government stepped in once again. This time it wasn't just about facilitating growth, it was about survival. The government's intervention stabilized the economy and paved the way for a new era of credit. Amidst these turbulent times, the government didn't just play a passive role. It was instrumental in establishing government-sponsored enterprises to facilitate lending. These entities served as a bridge between the government and private sector, making loans more accessible and affordable for the American people. By doing so, they played a pivotal role in democratizing credit, making it a tool for economic empowerment rather than just a privilege for the wealthy. So as we delve into the history of credit, it's clear that the government's role was not just regulatory or supervisory. It was an active player, a catalyst that stimulated growth, stabilized the economy, and democratized access to credit. The government's intervention in credit markets played a pivotal role in shaping the American economy and society. And as we continue to explore the history of consumer credit and debt in America, we'll see how these interventions have left a lasting impact, shaping the credit landscape we navigate today. Fast forward to the 21st century, how has consumer credit evolved? Well, the modern credit system has taken quite a leap from its humble beginnings. It's become more diverse, more accessible, and more technologically advanced. In the early stages, credit was a simple system, primarily between merchants and consumers. Now it's grown to include a wide variety of lending products, each tailored to specific financial needs. The rise of credit cards, for instance, has revolutionized how we approach everyday transactions. They've become a staple in our wallets, allowing us to buy now and pay later. Then there are auto loans, making car ownership a reality for many who otherwise couldn't afford it. Mortgages, on the other hand, have made the American dream of homeownership possible for countless individuals and families. And let's not forget student loans, which, despite their contentious nature, have opened doors to higher education for millions. But it's not just the products that have evolved, it's also the way we access them. Technology has played a crucial role in shaping the modern credit system. With the advent of the internet and digital platforms, getting a loan or a credit card is no longer a lengthy, paperwork-laden process. Today, you can apply for credit from the comfort of your own home, get instant approval, and manage your accounts with just a few clicks or taps. It's all about convenience and efficiency. However, these advancements have also brought their own set of challenges. Issues like identity theft, data breaches, and online fraud have become rampant, requiring constant vigilance and improved security measures. So, while the modern credit system has certainly come a long way, it's also a testament to our society's adaptability and resilience in the face of change. It's about finding a balance between convenience and security, between accessibility and responsible lending. The modern credit system, with its diverse lending products and digital platforms, is a far cry from its humble beginnings. The journey from barter to digital transactions truly is a remarkable story of human ingenuity and progress. What does the future hold for consumer credit in America? As we ponder this, we must consider several key factors that will shape this narrative. Firstly, technology. In the digital age, the face and function of credit are poised to change dramatically. The rise of fintech, or financial technology, is already revolutionizing the credit landscape. As artificial intelligence and machine learning become more advanced, they're expected to play a larger role in credit decision-making processes. Algorithms could potentially assess credit risk more accurately and efficiently than traditional methods, leading to more personalized and competitive credit offerings. Moreover, blockchain technology could bring about a seismic shift in how credit is managed and recorded. With its promise of security and transparency, blockchain could eliminate the need for intermediaries like banks, leading to peer-to-peer lending models. This could democratize access to credit, opening doors for those traditionally excluded from the credit market. Secondly, regulatory changes will also shape the future of consumer credit. As technology evolves, so too must the laws and regulations that govern its use. We're likely to see more stringent data protection laws to safeguard consumers' financial information in the digital age. Additionally, regulators might need to adapt to the rise of non-traditional lenders, ensuring fair practices and consumer protection. Lastly, we should consider the increasing focus on financial inclusion. Efforts are being made to ensure that credit is accessible to all, regardless of socioeconomic status. This could lead to innovative credit models that cater to underserved sectors of society, such as microcredit or community-based lending. As we contemplate these potential trends and developments, one thing is clear. The future of consumer credit in America is poised for change, driven by technological innovation, regulatory evolution, and an ever-growing commitment to financial inclusion. As we look forward, the future of consumer credit is likely to be as dynamic and transformative as its past.